Well, actually, as I said, it's done very well versus gold over the last year.
Yeah.
It's really not underperformed as most people think. Why? Because silver has these bigger pullbacks, and therefore, but you measure. If you're an investor, you don't care about this week or that week. You're looking at month to month, et cetera, and maybe don't even look at it till the end of the month. Say, what happened last month? Okay, and it's very good. But its spread relation to gold is very cheap still. It's 1.14%. Divide an ounce of silver into an ounce of gold. Now, if you go back 50 years and look at each year, how high did silver get on a percentage basis to an ounce of gold in that 50-year period? 20 of those years, it reached at least 2%. Whoa. Okay, if we break out over the near-term action, then we plot it. There's a nice downtrend line on that spread right now that since that October high in silver at 35, the spread made a peak then, and it's created a very clear downtrend structure. So when you break out above it, it's saying, okay, I'm back. Okay, silver's going to outperform. If you just take it from 1.14% up to 2, which is normal, 20 years out of 50 is hardly abnormal.
Right.
And say, oh, I'm back to, normal. That's a doubling of the price of silver in relation to gold. So, over the next year, if it went to 2%, that means if you bought silver, you made twice as much money as you did owning gold. And it could even be more than that. So I think we're in the same situation with silver versus gold and miners versus gold. We're on the cusp of the new money flow, largely from a broken U.S. stock market bubble, seeking alternatives. And frankly, if you do the math, you'll see that silver, it's up around 40% over the last 12 months, February to February, okay? S&P, I just checked, up 16.8%, okay? I thought the stock market's beating the pants off gold and silver, okay?
Right.
Up 16.7% the last 12 months, February close to February close. And silver's up more than twice that, and yet nobody's cheering. Silver's a dog. Okay, well, fine, whatever you want. We see it not as a dog, but as a dog on a leash that's ready to run out in front of the mama market and pull the mama market. So that's what we see for 2025 is probably the best place to be. And I think this pullback, consolidation, et cetera, is just more repetition of, if you look at a silver chart of the last year, it went from 25, 26 up to 35. Now it's trading either side of 32. Okay. But if you bought every 10% pullback that you were offered in that move, you're beating the pants off the guy who just chased the highs, okay? Every time it looked dark, buy it, because the big picture says it's light, not dark. So anytime the mobs say, oh my God, that's the top, we're going to correct for 8 months, it's going down 50%, buy it. And that's been the lesson, especially of the last year. Historically, the T-bonds and gold have beat the S&P during bear markets. And there have been periods in those bull markets in gold and bonds where S&P was going down. And there might have been a month where, gold had a bad month too. But basically, it was part of an uptrending process.
Silver has often been viewed as gold's less glamorous counterpart, but current market dynamics suggest that silver may soon outshine expectations. Over the past year, silver has quietly outperformed many traditional asset classes, gaining approximately 40% between February 2024 and February 2025. By contrast, the S&P 500 rose about 16.8% over the same period, and yet silver remains largely overlooked by the mainstream financial media and retail investors. This creates a fascinating divergence. While public attention is glued to risk-on assets like Nvidia, Bitcoin, and the broader AI-driven tech surge, some of the world's most informed and well-capitalized players are quietly building their positions in precious metals, especially silver. One of the clearest indicators of silver's undervaluation is the gold-to-silver ratio, which currently sits around 1.14%. Historically, this ratio averages closer to 50-1 or even lower. In fact, over the last 50 years, there have been at least 20 years where silver has reached 2% of the value of gold, nearly double where it is today. If the ratio simply normalizes to historical trends, it implies silver has significant upside potential. If gold holds steady and silver moves from 1.14% to 2% of gold's value, we're looking at a potential doubling in silver prices relative to gold. This kind of move isn't just theoretical, it has precedent, especially during explosive bull runs like we saw in 1979 to 1980 and again in 2010 to 2011, when silver dramatically outpaced gold's gains. Analyst Michael Oliver has long pointed out that silver tends to underperform gold early in a bull cycle, only to outperform dramatically when the move gains momentum. In fact, silver's violent pullbacks tend to shake out weak hands, setting the stage for stronger rallies once accumulation resumes. It's not just retail investors who are missing this. Mainstream financial advisors, fixated on conventional equities, continue to ignore the setup forming in the silver market. But those who study market spreads, momentum shifts, and structural breakouts know better. The chart patterns and historical signals are aligning in favor of silver, and the time to accumulate may be now, before a parabolic move catches the majority off guard. Adding to silver's bullish case is the increasing industrial demand, particularly from the solar energy sector. As global infrastructure pivots toward renewable energy, silver's unique conductive properties make it a vital component in solar panel manufacturing. Demand from this sector alone has grown by over 150% since 2019. With limited mining supply and relatively low recycling rates, the physical silver market is beginning to show stress. Combine that with global inflation pressures, unstable sovereign debt markets, and questions surrounding fiat currencies, and it's clear why silver is not just an industrial commodity. It's a monetary metal and a potential safe haven. Yet despite these bullish fundamentals, silver's pullbacks have been met with yawns from the mainstream. The reality is, silver remains the most undervalued monetary asset on the planet, especially when you consider how it's performed versus gold in past bull cycles. According to Oliver's momentum models, once the silver to gold spread breaks out from its current downtrend, which it appears poised to do, it could trigger a wave of institutional buying, potentially lifting silver to $50, $75, or even $100 per ounce within the next market leg up. Investors who have the foresight to accumulate before that shift will be positioned to benefit handsomely. 2025 may be the year when silver breaks free from its long-standing slumber and surprises the world. Whether you're an investor seeking to hedge against macroeconomic risk or simply someone who recognizes that the crowd is often wrong at key turning points, silver deserves a serious look. As history has shown time and time again, when silver starts to move, it moves fast. Those already holding will be rewarded. Those arriving late will be chasing, and those who never looked, they'll be wondering how they missed the most obvious play in a world that's increasingly unstable and searching for financial truth.
And I think we're at that point now where if you break the stock market, that money flow will cause acceleration in this arm wrestling bull trend that gold is in, and the miners and silver. And I think you'll notice a tonal difference. And be there before the mobs. Okay, let the mobs chase it. That's fine, but get there before. And that's what we're trying to time is the spread breakouts, because those spread breakouts often are very well timed to the points of acceleration in price. This was true back in the 1979-80 bull and back in the 2010 to 2011 phase of that bull market, where the spreads broke out and silver beat the pants off gold in that last year. I think we're on the cusp now. I think we're set up for another major top and downturn. Except this
in the stock market.
It should be worse, in the stock market. And I think that's the key factor for gold people to pay attention to now. Because when that guy goes, when the money flees, it goes somewhere else. It has always gone into gold. If you go back and examine .com top, 2007 top, mid-1970s, gold roared up to 1975 while the stock market was getting killed. In fact, it crashed in 1974, the stock market. So total opposites, including back in the 1930s when the Dow dropped 82% between 29 and 32 low. They didn't have gold because it was illegal, but home stake mining traded went up like 1,000% because gold miner. So gold is the alternative. So don't be deluded by tick comparisons of, today's down, so is gold. S&P had an hourly rally, so did gold. Don't get deluded by the micro because the macro is different. And gold is going to get an infusion of new capital by investors who suddenly say, oops, I need to get out of this. And not all the money gets burned up in flames. It moves. Another place it'll move will be T-bonds, and they're already starting to now catch up to what gold has already been saying.
Right.
Money flow.
Right.
That's the other alternative. So anyway, I think that's the thing for gold people to watch now. crashes are unusual in markets. In 29 we had one. In 87 you had one, but in 87 the crash ended, and that was the end of the correction.
Yeah.
Because it was only breaking certain metrics, and its annual momentum fell down to support in that crash. So it didn't break that long-term structure.
Now let's push a little deeper into the dynamics fueling this hidden surge in silver and gold. Because what we're witnessing isn't just market activity, it's a fundamental restructuring of how value is perceived across the globe. We've talked about silver being undervalued relative to gold, about the miners being underappreciated, and about the retail public being entirely distracted by the allure of Nvidia, meme stocks, and cryptocurrencies. But beneath that surface, seismic capital flows are revealing something astonishing. The world is rebalancing toward real, tangible assets. The kind you can hold in your hand. The kind that central banks, not TikTok influencers, are stockpiling with a feverish urgency. The reason is simple. Paper is faith, metal is truth. And in 2025, that truth is becoming harder to suppress. What many forget is that silver, unlike gold, has one foot in the industrial economy and one in the monetary realm. It's not just a hedge, it's an engine. And as the green energy transition, electric vehicle production, and solar demand explode across the globe, silver's industrial base alone would be enough to support prices much higher than today's. But now, with the monetary system increasingly unstable, silver's dual nature is turning it into a financial escape hatch. This is a key reason why insiders and institutional players are quietly rotating into silver, not just as a hedge against inflation or dollar weakness, but as a bet on monetary reset. And let's be honest, resets happen more often than people think. The last major reset was 1971. The one before that, 1944. History doesn't just rhyme, it often repeats in cycles of crisis and reconstruction. And every time, gold and silver have been part of the solution. So how do you position yourself for what may come next? First, understand that timing the exact day of a revaluation or monetary shift is like trying to predict the first raindrop before a storm. But what you can do, what central banks are doing, is prepare. That preparation involves accumulation, not speculation. It means building your position now when the crowd is asleep and the noise is elsewhere. This is why technical indicators, like those highlighted by Michael Oliver, become so crucial. They cut through the emotion and point to structural changes beneath the surface. When spreads break out, whether it's silver to gold, miners to bullion, or physical to paper, you're not just seeing numbers shift. You're watching capital rotate. You're seeing conviction quietly form in the smart money. These breakouts are warning flares for what's to come. Let's talk a little more about those miners. People often overlook them because they're messy, volatile, and not as sexy as gold bars or silver coins. But the upside potential in quality mining stocks, especially silver-focused producers and explorers, is absolutely enormous at this stage of the cycle. In fact, some miners are still trading as if gold were $1,200 an ounce and silver were $15. Meanwhile, the metals are pushing toward triple their prices from those years. This disconnect can't last. When capital finally rotates into miners, and it will, the results will be explosive. We're talking about potential 5 to 10 baggers in select names. But again, it comes back to positioning early. You see, investing in silver isn't just about catching a trend. It's about rejecting the fantasy that paper promises will always hold their value. It's about hedging against systemic risk. It's about recognizing that when the entire system is built on credit, on leverage, and on derivatives of derivatives, then owning something not dependent on someone else's ability to pay is the ultimate form of financial independence. Let's take it a step further. Consider what happens if the next financial crisis isn't just a crash, but a collapse in trust. We're already seeing the early signs. Banks debanking customers, governments freezing accounts, institutions lobbying for digital IDs tied to central bank digital currencies. In that world, gold and silver become not just hedges, but necessities. They're outside the system. They don't rely on servers, passwords, or government permission. And here's a bit of humor. You don't have to worry about your silver bar getting hacked or locked behind a firewall. It just sits there, doing its job, preserving your purchasing power across generations. No download required. Now imagine a world where the US Treasury actually does revalue gold to rebalance its books. Let's say gold is moved to $10,000 an ounce to plug holes in government debt and restore confidence in Treasury markets. What happens to silver? Does it stay at $30 or $40? Of course not. Historically, the gold-silver ratio tightens dramatically during monetary resets. In 1980, that ratio hit 15 to 1. Today, it hovers around 80 to 1. If gold goes to $10,000 and the ratio tightens to even 50 to 1, that puts silver at $200. If it moves to 30 to 1, that puts silver at $300. That's 333 silver. Does that sound crazy? Perhaps. But so did $3,000 gold 10 years ago. This is why understanding cycles and human psychology is vital. Most people will only buy silver after it breaks out, after it's in the news, after the price has doubled or tripled, and by then, premiums will spike, inventory will vanish, and physical delivery delays will stretch for months. We saw it in 2020. We'll see it again, but bigger. So what should you do now? Start simple. Accumulate physical silver. Focus on low-premium, liquid formats, government-issued coins, 1-ounce rounds and bars from reputable mints. Diversify across storage options, some at home, some in secure vaults. If you want leverage, consider mining stocks or streaming and royalty companies. But always anchor your position with physical, and don't wait for the world to wake up before you act. Because by then, you'll be buying from the same people who had the foresight to buy when no one was looking. In closing, let's be clear. The time to act is before the crowd. Silver isn't just a speculative trade, it's a lifeboat. It's a form of generational wealth. It's what your great-grandparents trusted when empires fell and currencies burned. And in 2025, as the global financial system teeters, it may be your edge in a world gone mad. The charts are screaming. The fundamentals are undeniable. The whispers are growing louder. Silver is preparing to run. And when it does, the gates may not stay open long. Get positioned now. You'll thank yourself later.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.